what is it about identifying the issue? So identifying the issue for me, it starts with the transaction. What is the transaction? What are we accounting for? I said discuss the financial reporting implication of the above information. But how are you going to think about it? Yes, as I said, the CTA candidate had one issue, but now I've now said no, I want the above issues. So always go back and say, what is the transaction? What is it that is happening here? So in this particular scenario, we've got a number of transactions that we are seeing. One, there was a licensing agreement concluded. So imagine with me, your company then acquired this trademark, and then you or the company and the owner of the trademark agree that this is a 5-year agreement. The day that they agree on the terms and they put their signature on paper, what do you think we have to do in our books? Do we do something? There was a transaction, there was a signature of a licensing agreement. Do we do something? Yes, there was no payment on that date, but does that give rise to something in the books? Do you understand where I'm coming from? That's the question you will want to ask, that the day they put their signatures on paper, was there any accounting transaction that occurred that we need to account for? In other words, when do we need to account for things? Is signing an agreement good enough? Or they needed to be more? That's number one. Because remember, we're identifying the issue. Number two, all right, so the agreement was signed and there's question mark in terms of what we will have done, but now the first payment came. So when the first payment comes, we are saying that there goes the payment. How do we then deal with the payment? Surely we know that our bank has reduced. So whatever we're going to do, we're going to have to find ourselves reducing the bank. But if we reduce the bank, what are we getting in exchange? So are we getting a different asset altogether? In other words, is that the point where we're actually buying the trademark or the right to use the trademark? Or is it the time where we are buying something to invest in the inventory? And now it begs the question that, do we account for transaction through payment? Or this transaction is simply paying off the liability that existed when the contract was signed? Because these are the questions that we need to be mindful of. So let's say, for instance, you go and you do what? You buy a car. And when you buy a car, the bank financed you. And what did you do? You just signed and you walk away. There was no impact on your bank account. And now you are driving that car, end of the month, the installment comes. So when you are making that payment, is that a payment to buy the asset? Or is that a payment to pay off the liability relating to the car? So in this case, what is the payment doing? Is the payment paying for the right to use the car, or is it paying off a liability that existed when you took the car and agreed to use it for a given period? Are you getting the legal nuances or things that tends to complicate our thinking about financial reporting? Because these questions are what are important. We need to be clear, what is the transaction? Because a payment for a liability and a payment for the right to use might be different, but what is it that we are paying for? Then we are paying for we are making a payment, but then we are also using. So here, then the question from Bevan also starts to materialize that what if we are required to pay and we don't use, and that has no bearing on the payments? So when we actually use before payment, or when we pay and then use, does that have any impact on the accounting that we need to be mindful of? So these are the kind of things that we are thinking about here. The transactions, we are using the license. So when I use a license that I have entered into an agreement to use, do I need to do anything in my books? Or the only thing that matters is the payment? Then I'm using it, but as part of using it, I use it when I produce the inventory, and maybe let's say it's the, what do you call it? The rugby World Cup sticker. Then I signed an agreement with is it what, rugby union or whatever. So that I need to what? Can I have the right to use that Springbok team what do you call it, icon or logo? Then I'm putting it on my sneakers. So I am using the right that I've paid for, but I'm now producing the inventory. So now what forms part of the cost of that inventory? Is it simply the payment, or there is another way to allocate the right that I obtained through what? Through that agreement to the cost of the sneaker? Like, how will this work? Then lastly, how then does it change when now I have some of the inventory on hand, and in the other instance, I've sold the inventory? So this is the transactions. And in a question like that, or in a task like that, it is important to be able to break down the issues into transactions. That is number one, because how you then identify or break down the issues will also determine how far you will then go. It will determine your scope of the issues. Does that make sense in terms of where we are? That the first thing, and the way, and the idea here is that this kind of questioning or identification, yes, it requires technical to know that these issues can be unpacked like this, but it also requires critical thinking to say, but wait, when you say the information above, what is that? There's this, and there are these things that you didn't tell me, or it's not clear. What about them? And so on and so on. But this is our starting point. We have a number of transactions that we need to account for, right? Any question on this? That these are the things, or these are the questions. Remember, we are not answering the question as yet. We are just what? Unpacking some of the things from the information. And this will then help us to start thinking about the different standards and how to go about applying them. But any questions so far? Okay. Then why is it important to identify the issue? Because I want to be able to understand whether an asset exists, whether a liability exists, and whether there will be income and expenses arising from these transactions. So identifying the issue really is to just ask yourself, what is then the asset and liabilities that will be affected? What is the income and expenditure line items that will be affected? And this journey always starts at the framework. So the framework, think about it as the foundation for the other standards. Think about it as the foundation for the other standards. So, and think about the standards, let's say as homes or houses. So now, if I say that, or companies here, let's think of, say, different companies offering different service. So yes, the standards will not necessarily, so they will build with from the fundamental principles of the framework. But if you need something, where will you go? You will then go to the respective building and you'll then get your what? Your requirements, whether it's goods or services from there. So the idea is always that when there are issues on the table, you first need to locate the standard that is relevant. It is only after you have exhausted and say, Anna, this transaction, I hear you, Rendani. I don't think the existing standard framework deals with it. Oh, then you go back to the foundation and then say, foundationally speaking, what are the principles that gave rise to these different standards? So maybe I can use that foundation to find a way to treat this particular issue that I've got. Oh, and if it's still not there, then I can go and ask any technical material that has been written on it. So that's how we think about the standard. So one, whenever we get to identify the issues, we will need to identify the relevant standards. So there's a couple of them nowadays. So there's about IS 1 through to IS 41, IFRS 1 or 2 through to what? To 16 or 18 nowadays. So that's the what? Those are the standards that we've got. So whenever you've got transactions to account for, your job is to find out which standard to use. So, and whenever you don't have an answer to that, you can go to the framework. So just to clarify, the framework then does what? It gives us a breakdown of what are things. It tells us what is what. So in other words, as framework tells us that when you hear in accounting that there's an asset, the definition is in the framework, meaning that all the other standards, they're going to use that definition of an asset. Then it's going to define a liability. All the other standards, when they say that you recognize a liability, you will then go to the framework to know what is a liability. When the standards say that this is income, then you will then go to the standard to find out what is the definition of income. So do you see how the framework works? So the frameworks or the framework, it then does what? It then lays the foundation for the other standards. But the other standard then says that I am an individual standard and I deal with assets that do not have physical existence. So I'm the intangible standard, intangible asset standard. Then the others will come and say, I deal with assets that are agricultural in nature. Then that will be an agricultural standard. Then the other will come and say, I am a standard that deals with properties that are leased out. So I am the investment property standard. But I am dealing with what? With the asset as defined. So that is where we start. That the framework gives us the definitions, but the other standards build on this definition and deal with specific transaction or circumstances or events. So when we are faced with an issue, we start with the standard that is specific to that issue. So we don't have to go all the way back and say, is this an asset? We have to have rationalized that there is no standard that deals with this so that we can go back to the framework. So we don't start down up, we actually do up down. Does that make sense? How we think about an issue. Are we clear on that?
Yes, happy Randani.
All right, cool. So now we've got what? We've got the framework. So the framework does not even define the standards that are there. It simply defines the characteristics. It defines the financial statements or things that we need to be mindful of when we prepare our financials. But it does not deal with any accounting. So we are there. So we want to be able to frame the issue. So it is therefore very important to get to this point, because when we get here, for instance, so let me now show you how this, you'll then come back here with that mentality. So again, this is just to help you to frame. We still need to answer the question. Now that you found out that there's a sale give rise to proceeds, obviously. The standard that deals with sales transactions, it's IFRS 15. So that means we might need to refer to IFRS 15 in responding to this question of what is the accounting treatment of financial reporting implications. The standard that deals with the production of inventory, it's IS2. So we will need maybe to consult IS2. The standard that deals with licenses, it is IS38, which is the intangible asset standard. So we will need to probably consult that standard. So that is why I'm saying the transaction-based thinking. When I see that there is a transaction, I will need to consult the relevant standard. And that standard might then give me guidance to say, whenever you enter into an agreement, you have to recognize assets and liabilities, or you have to wait until you know the payment or whatever, but I will therefore get the guidance from there. So that is the first thing that we need to do with regards to what? With regards to identifying the issue.